Earnings season is well underway. JP Morgan, Wells Fargo, United Health, BlackRock, you name it. Alongside with this, the trend line on S&P 500 is going to be way in once again. Once again, that is make a break time. So it's amazing time ahead for investors, decision makers. But we still need to bear in mind all of those headwinds that we literally swear. Supply chain problems, war in Ukraine, skyrocketing inflation, high interest rates. How to give a credence that everything going to be fine and we are going only up from here. My name is Rafał Leszek. Welcome to next episode of Blockrevision. Today we are going through indexes, commodities, crypto. You will find everything interesting in terms of the newest market updates. So let's begin. All right, economy view is something that we are pondering over at first. So at first, I'd like to know that you are having a good quality of sound, as I have some issues, so you may write it down in the chat that's going live. And we are kicking off the transmission. So, economy view, what we had of first. Fed on track in terms of its interest rate progress, but the question is how long? So the Fed is on track to downshift to smaller interest rates increases following a further cooling in US inflation, though it's likely to keep hiking until price pressures show more definitive signs of slowing. We are still taking care of inflation, however. Resilient consumer demand, particularly for services, combined with a tight labor market, is a significant threat to prices. The things getting worse, unfortunately, already. So the pace at which rates have gone up is tremendous, more than we've ever experienced before. So the headwinds might be also unexpected, and there might be lots of things that may get us embarrassed. So the need for caution and patience right now to allow some of these impacts to filter through the economy is more than understandable. So getting once again, I've been saying this to death. Imagine a world where the Fed started to slowly increase rates 6 to 9 months before they actually did so. They have many pundits out there that they may advise it. But we still would have faced an inflation hump, but there is no damp way, or rather no damn way it would have been so pronounced as it's right now. So there's a question, soft landing or the hard landing? Even if at any means we'll achieve this soft landing, we still need to strive with such elements as political dysfunction, divided Congress, that giving those elements of budgets and cut spending more problematic. Also, COVID-19 pandemic that's it's largely over, but there are some waves on the side with this some aforementioned Kraken subvariant of a COVID that may also threat the markets. Also, political risk abroad. That's things could get worse in Russia or even China and Taiwan. So right now, the biggest risk from an outcome of this scenario right now that we are dealing with is that it undermines the economy's resilience for future shocks. So if we just go with a barefoot through with a I would say with no or we won't find on a collision course with a what's heading in front of us, that will make it make the economy more resilient to future shocks, which leaves us more vulnerable for longer to whatever comes next, I bet. That's why the easiest path might be somewhat milder in its consequences, maybe more touchy, but in the long run, we will suffer probably much, much worse. That's why I would like to have these things over, but with this yield curves inverted and trying to revert, there wasn't a time in a recent century that we'll go through this untouched by and unharmed by the things that got so bad. But my question right now, it's like a thought experiment. Fed is also very often repeating that they need to break something. So with those interest rate hike, they expect lower labor gauges. But what if we are in a labor market that is structurally different from prior periods? Just look at this one. So we are expecting an unemployment rate September projection at 3.7, 4.6 in 2023, and at 4.6 in 2024. But look at United States continuing jobless claims. We are forming a lower lows, aside from the spikes when there was a crisis. It's so with those lower lows, almost every single time, we may go through even lower levels from here. What if the cause of the tight labor market is due to low immigration? And also, we are dealing with decreasing productivity and declining demographics. So these aren't the sort of problems that Fed rate increases are good at addressing, notwithstanding driving the economy into a serious recession. But I don't think this is an acceptable or reasonable policy option whatsoever. So what I mean, we shouldn't scare the economy, shouldn't scare the market of what may come next, as we do not know, as there are too many variables, and assuming that we may go only down from here is somewhat harmful for the economy, and I wouldn't stay by what Fed is talking to. As it's like a self-fulfilling prophecy when the Fed, that's the very powerful large institution, tells that something is going to break, we are mentally getting prepared for it. It's always like getting tuned for the best, but also be prepared for worst. But if we are saying this out loud endlessly, we are literally programming to this. All right. So that's why I wanted to mention this one. But we are right now heading into current market sentiment and the current outlook. Anyway, we'll go through market outlook in the next section in a moment. But at first, let me find out this metrics. So it's kind of a interesting speculative retail buying of upside calls has disappeared. So that's the chart. It's an aftermath of yesterday's skew analysis. If you haven't watched it, you may do it right now. Also, if you enjoying the content, drop the like button just for just for making it this episode more more possible to spread over internet. So speculative retail buying has disappeared literally at various points in 2021. Over 50% of stocks in the S&P 500 top 100 had inverted the call skew. Now the number is at 0%. So it's going to be by these metrics better time to jump into stocks. So previously same time was back in the first quarter of 2022 when we had this very negative sentiment around, but for longer time of such a poor sentiment we had back in May of 2020 after this COVID outbreak, and that's where biggest rise on the markets, biggest returns been noted. So we are not maybe as flatlined as back in May 2020, but definitely this plateau is getting closer and closer. So if you're wondering about being more aggressive right now, it's maybe a great time to think of it yet. So all right, we are heading next market outlook, and for this one let me find out, as we are right in the beginning phase of an earnings. So I'd like to have a look at what's going on the charts. US 100. So on majority of earnings publication, we have literally has withstanded with that expectations that were much of a good, but with projections to the possible mild recession. We'll go it through in a moment in another section, but for now, US 100, as we can find it now, setting off on a news that right now there is no more catalyst that may push it forward. So market was playing for relatively good outcomes out of the first day of earnings calendar, but the projections are somewhat scary to this. That's why this US 100 is right now losing in its valuation. Okay, so we are getting back once again into market outlook, and that's, however, somewhat positive. So VIX, as you know, it's an index of fear, right? So it measures the volatility of the market. When it's over 40, we are dealing with a recession, with a hard recession, and where the fear is largely high, whereas right now we are dropping below 20. So it means that we are no longer repeating the pattern of those spikes and lows of a 3 months span. Right now, where we were after this another spike right on the beginning of 2023, and in December it has backfired. So it means that for the market, this fear should eventually dissipate, and we'll go through hopefully much easier conditions that we have been dealing than before. So right now, lower lows playing in and thereby discounting risks mitigation. That's what I have recapped this slide with. Heading off next, crypto outlook in a very interesting spot. So, is that a time for having this bull run at the beginning stage? So, as you know, we are moving on a crypto currency, especially Bitcoin, 4 years halving cycles. So when there is a halving, so it means the reward for the miners halves during that time every single 4 year. It usually sparks a bull run. So the spark of a bull run usually comes up around 1 to 1.5 years after that event to happen. When it was in a 20, the halving was in 2020. Sorry, was it 2020? When was the last halving? Sorry, it dropped my mind. It was somewhere around 2019, 2020. But supposedly that was, yes, that was 2020 in the May, as I remember correctly. And therefore, we had a bull run starting from the end of 2020 by 2021. So from now on, the counting has begun. We are right now 378 days from the highest point to the bottom right now. So it means we have dropped for over a year, and that's almost aligning with previous cycle bottoms. Drawdown, however, might be a bit higher, but as we do find, drawdowns also are diminishing, so it means it may not get much worse from here. As you can find, the difference between a first cycle drawdown and the second cycle is at 8%. So this time, around 7% is something of a still acceptable difference, and shouldn't be a subject of a dispute in this type of comparison. So that's very interesting to study. Merely on this gauges, we can find that the calculation right now gets us to a new all-time high that we may fall on 2024. But what may spark the bull? So recently we've been going through the period where lenders of a mining equipment has been underwater. So there were many companies that couldn't deal with this energy crisis, where they had to supply the energy in order to have their machines going, in order to, mining Bitcoin. But right after 2021, when the things got only worse, lenders started to really suffer. But there is a time, as it's right now, where lenders can recover some losses if they can find reliable Bitcoin mining facilities with cheap electricity. And even when they hard to find, lenders may still choose to sell some of the machines, even at steep discount, but they may also want to sell them, or even don't sell at all. So more miners, as so-called aforementioned in our episodes, Core Scientific Incorporation went bankrupt, and it depresses prices further. But as right now, we can find that still many defaults are going up, and even with that elements that crypto firms are cutting more than recently 1,600 jobs, as we found on Bloomberg, the price hasn't reacted to this bad news. So, getting back to the first topic, crypto lenders may have repossessed so many Bitcoin mining rigs, they are resorting to plugging them in and extracting tokens themselves. So lenders are flooded with mining rigs. One way for the lenders to prevent further losses from the defaulted loans is to keep the collateralized machines running and generate some income. And that's what probably may happen, as selling those machinery at loss right now is somewhat unreasonable. But they may right now mine those cryptocurrencies, betting on the more remarkable future. So when the price of the cryptocurrencies go up, they will try to recover, and afterwards will eventually thrive and get back to a business of supporting this hash rate of Bitcoin chain. So many bankruptcies, many problems were underway, but as we do know, even if those companies having been going through problems, even this cryptocom company that has caught up the one brand that's added ads, you were able to see that on the Qatar stadiums during Mondial 2022. That right now is getting into trouble, but those who might have sold probably already did it. So as we can find, as the price action of Bitcoin doesn't go downward, we may expect that we are somewhere in the beginning stage of this bull run to commence. So I do rather expect those crypto lenders to plug that equipment once again to their mining rigs, and eventually try to recover with these problems of industry gradually fading away. All right, and why is crypto so luring? Just look at this. Look at this projection and percent of simulation based on a few hundreds examples. Percent likelihood of crypto portfolio growth: 10 assets held for 6 months. So probability of 10xing, so increasing your portfolio by 10x during the time of around 4 years, getting to 10%, whereas 2xing your portfolio, getting to around 90%. That's why everybody is waiting for catching this dip in crypto and then ride the wave. So we can find that timing on the market is nothing novel. The low likelihood of gains from 2018 and 2019 investments is surprising. But if you like to buy somewhere in the beginning stage of 2017 or 2020, you might get rich quickly. But you do know that it's very difficult to time the market. So there are very often juxtaposed gauges that may indicate that the bull run may commence, but just the time doesn't work. So it's always much better to sit on this bag of cryptocurrencies and ride the wave despite even the downturns or the upturns. But the key point is that you need to buy when the sentiment is low, and that's where we are right now. So right now, the 2023, the patience is absolutely the virtue, and hopefully current investors will be patient enough to not sell on the current trough we are at now, in order to deepen it even lower. All right, so we are right now heading into market mover section, and what we got out there is that economic calendar. On economic calendar, we have this week. Let's jump it back. So right here you have had a data out of Great Britain. So GDP month over month right now is getting to 0.1. So we are slightly recovering out of this recessionary span of time. And inflation rate out of France at 5.9% right now is showing a stoppage, whereas a full year GDP out of Germany right now is slightly below 2%. So it's a like more recessionary period than the previous year, but still nothing much of worry. So more and more, I would say, market analysts are expecting that those strongest economies alongside Germany and France will avoid recession. But as we have found, the IMF, was it IMF? Yeah, if going down the memory lane, possibly that was IMF that expected that we'll deal with a global recession this year, as 1/3 of countries around the globe will fall for recession. But those are the strongest economies of Europe that may go through this untouched. Even with this energy crisis that fortunately doesn't look as bad as it seemed at first. So also Michigan consumer sentiment, we are waiting for today. Fed Hawk speech told that 0.25 is expected at the next meeting. But what we have of here right now, let's get to earnings calendar. Everybody's been waiting for. So what we have right here. Trading economics, yes, that's the table right here. So once again, I've told you previously, but right now let's just have a straight look at the data. GDP month over month right now is from Great Britain at 0.1 and better than the forecast. Inflation rate out of France as expected, and Germany 1.9 in expectation with 1.7%. It's better than the forecast. So somewhat we are getting out of this trough, fortunately. All right, but we are quickly jumping into the earnings calendar, and disturbing that. So for now, as of now, maybe I will refresh it. Yes, so majority of the companies from the today's spectrum of earnings has noted better gauges than the forecast. So it's building up for for the economy, for the stock market. Citigroup was the one outlier alongside with Aon idea. So it means that the strongest companies are doing well. Also, what's the projection? Because it's not all about the earnings, but about the projections of the companies. So US futures for Australia, that's not a big bank earnings, right? So that's nothing right here. But JP Morgan profit jumps, but bank now predicting mild recession. So that's what I told at the beginning. Bank recently has noted better than expected fourth quarter that bodes well for the next period. They are expecting a mild recession. But what about UBS? UBS. No, that's multi-asset strategy. Sorry. What I meant is to look through Bank of America. Yes, Bank of America right now has found that we ended the year on a strong note, growing earnings year over year in the fourth quarter in an increasingly slowing economic environment. So it's positive, and even if those main indexes have been dropping on this relatively negative outlook, it's still nothing much more worry about than what we've been discounted on previously. All right. So by and large, this earnings season starts well. Okay, so it should give a boost for the indexes to thrive. And we are jumping into a trade idea, and what we have out there is that SPX. Just have a look at this one. So it's in a decisive point right here. Let's extend the view as that. So SPX right now is going into this trend line that right now is with a high probability to test once again. It was tested around 6 times or 5 times already. So the more the more times we are testing this trend line, that the higher likelihood will go through this. So as the dominant trend line is the rising, and as we are possibly going upwards, right now we are building somewhat of a base that should push us forward. So such of a accumulation of a volume, and also such of a squeeze that we are right now on a monthly chart is just waiting for the better seasonality, as January is most often than not a pull for the outcomes, for the returns of broad market. One of the concerning note is that the broad of the market already has crossed the trend line, and right now is heading upwards, maybe even up to next. Maybe if I just to show you. Sorry. What I'm about to show you, RSP. It's a equal weight ETF that shows a broad strength of the market right now has broken out of this trend line. Oh yes, that's what I meant. Has broken out of this cup and handle formation. So that's also what may happen to S&P 500. That's what I would like to watch So S&P 500 right now, if it get through this trend line, I would wait for somewhat of a battle between bulls and bears. So it should be the struggle right here to get out of this trend line. But if it gets through, it will be possibly another stop at 42.7. So it's it will be very interesting to watch. So I don't give you any type of trading proposition as of now, but I've got the natural gas information that it's broken down. So it looks like it looks like it's supposed to get even lower as we have crossed this support. But observe the reaction right here. What will happen if it gets back upwards? It means that it might be another fake out. But with another attempt going downwards, I do expect that on natural gas we are heading lower to 3.03. All right, so those are the propositions. I don't give you the exact guidance on what will happen, but those are the most interesting right now to watch. So SPX and natural gas alongside. So that's it in today's episode. Thank you very much for watching, and see you on Monday, quarter to 9 a.m. East time.